Ah, the mortgage changes. Yes, what fun. We've been hearing about this for a couple of years now. Well, the changes have happened. How do they affect you and me when we go to buy our next home? That's what Marcus Tzaferis is here to talk about. He's an economist. He's founder of MorCanDirect.com. And this is your life. You're always scouting and forecasting what's happening in the mortgage world, right?
Yeah, for almost 15 years now.
So take us back to maybe when these mortgage changes were first announced, and how did that affect the economy?
So the first iteration of the rules that we saw implemented in January actually came to the market in October and November of 2016. The federal government imposed a rule that any non-bank lender, we call them mortgage finance companies, you may know of them by names like First National and Merrick's Financial and Street Capital. These lenders were told that they needed to qualify all of their borrowers at a rate that was 2 percentage points higher than the rate that they were actually being given. So that's the kind of, they call it the posted rate.
Kind of, oh, okay. So that they're people like me who were wanting a mortgage, they could vet us as being able to pay. If it was higher,
exactly,
could they still pay that? Okay.
Exactly. I think the federal government was worried about a possible price shock. So, it probably served two purposes. It served the purpose of slowing down borrowing, because, as you know, the Bank of Canada, continually says in their reports that they're worried about the pace at which Canadian consumers are taking on debt. So by increasing the qualification rate, it slows down the amount of money that people can take out of their homes and they can start utilizing. And I think that the worry is that they're utilizing that money for bad things, for disposable spending, for cars and boats and living. And if inflation or the rate of wage increase isn't keeping up with the appreciation of pricing or what they need to spend, and they continually tap into the equity in their home, that's a bad thing to maintain their lifestyle. So out of, I guess, a bit of a fear of that and in wanting to slow down borrowing, they institute a policy that any non-bank needs to qualify their borrowers at the bank posted rate. And at that time, I think the rate was probably about 4.8, 479 or 489, and the prevailing 5-year discounted rate, so the rate that you or I would get if we were shopping for a mortgage, was probably closer to 2.5%. So there's a big difference, and this applied to consumers who had 20% to put down on a home or had a home with 20% or more equity in the home. Okay. So we're not talking about high-risk borrowers. We're talking about borrowers that have a good grasp on their finances and are using the equity in their home or looking for a better rate. So once that was implemented, we definitely saw, prior to it, we saw a rush of people trying to get in with these companies. And after it was imposed, we saw less competition for the banks. So now all of a sudden, the banks were the only place you could go to get an interest rate and to qualify for your mortgage at that interest rate. If you wanted to go anywhere else, you'd have to qualify and use more income to qualify.
Gotcha.
So we saw almost artificially interest rates on mortgages increase. As the banks had reduced competition, they increased interest rates. So we saw a bit of an uptick in interest rates when typically fixed rate mortgages are tied to bond yields. So fixed rate mortgages are issued and they're backed by Canadian real estate and in many cases the Canadian government. As such, the yields on those mortgages are tied to bond yields for the Bank of Canada.
Okay. So that was how it started, and here we are now. The new changes affect who?
So the new change is basically them taking this rule, everyone's got to qualify at the posted rate. When it only applied to the mortgage finance companies, they're applying it now to the banks as well.
Aha.
So anyone that is looking to get a mortgage now, in today's market, needs about 20% more income in order to qualify for the same mortgage that they would have qualified for on December 31st, if they could have found someone to do a mortgage on December 31st.
Tough for first-time buyers, right? Tough for people who are already kind of on the edge of being able to qualify.
Yeah, very tough for first-time home buyers, but tough, if you think about it, tough for anybody that is looking to utilize the equity in their home for any reason at all. So we're blanketing now everyone. We're blanketing the small business owner who may use the equity in his home to finance expansion in his business. We're blanketing the couple that wants to borrow money off of their home to max out their RRSPs. We're affecting users of debt in good ways and bad ways equally. And that has the impact of slowing the economy down. When you reduce access to capital at the rates that we can offer on mortgages, you're going to end up slowing the economy down. Is
there a positive to this? How can you help us?
So I think there's two questions there. Is there a positive to this? I am hesitant to say that we will know the full impact of this policy change when we don't actively gather all of the information that we need to make these policy decisions. I'm positive that the federal government and the Bank of Canada have tons of leading indicators that show them, what direction policy should go and why or how they can slow a market down. What concerns me is that being in the real estate industry for the last 15 years, I know that there's really no one quantifying foreign money coming in to the market.
We're talking about, yes, the money that people who are immigrating to Canada bring in.
Right.
And a fair bit of that is Chinese money, right?
Mm-hmm. So if we're not quantifying how much money is coming in from China and how many Chinese buyers are buying our homes, how will we know that a policy change that is designed to affect only Canadian households will prevent price appreciation? And if, in fact, the amount of money coming from China is greater than what we guess it to be, because it is essentially a guess at this point, then perhaps, we're in January going into February right now, perhaps we will continue to see price appreciation. Perhaps this will not slow down the, the hotbeds of activity that the Bank of Canada and the federal government are worried about in Toronto and Vancouver. Perhaps they're going to continue to increase in value, and perhaps all we're doing is preventing a Canadian borrower, a Canadian household, from accessing the equity they have in their home. And if property values continue to increase, which is, again, if property values continue to increase in the face of this policy change, I think it will tell us that there is more Chinese money, there is more foreign money coming to the market than was accounted for.
I feel like we could talk about this all day. We've got just enough time for you to tell us how, if we wanted to refinance, can we call you? Can we get in touch with you? Will you help us?
Of course. So MorCan Direct was, we started about 15 years ago, and we started it with a really different platform than any other mortgage brokerage in Canada. Whenever anyone calls us, they're dealing with a salaried mortgage specialist, not someone who's on commission to try to sell them something. We offer sound, unbiased mortgage advice to anyone that calls our offices. And our job is to help the Canadian consumer navigate the rules that were just enacted and any future changes that may happen on the in this mortgage and real estate landscape. So they can expect to get unbiased advice as to how they can prepare or weather what's happening right now.
Brilliant. Marcus, thank you so much.
Yeah, thank you.
MorCanDirect.com.
Yep.
We'll find you. Marcus, thank you so much. Thanks for being here.
Thank you. Thanks for having me.